Well, hello and welcome to episode 7 of the Energetic Incorporated podcast. I'm Kevin Bambury, your host. So we've just had Warren Buffett retire. And people look back at his career and say, what was he really good at? Buying and holding. Buying good companies, sticking with them over the long run. They compound, they do well. So that's a strategy that many people naturally want to follow. But the reality is that especially now that we've moved to fiat currencies, pure fiat, excessive money creation, we have this whole problem of nominal returns versus real returns and struggling to try to get those real returns that matter the most. And we also have periods of time that we go through in the markets, whether it's an 87, a 98, a 2008, the dot-com meltdown, these big moves that if you could avoid that, if you could sidestep those and do better, you're going to be way ahead of the game. And instead of taking that Morgan Housel approach of just buying the market or the S&P 500 and just sticking with it, I like to dig down into the internals and say, which sectors have become bloated and overvalued and are subject to poor risk reward and might suffer a correction, and they will go down as a percentage of the S&P 500, and which sectors are going to rebound from a historic low. And we see things like the commodity markets now at historic lows, and we see things like the tech stocks and financials being near historic highs. And so not only does the overall market, when it's on a 10-year cycle, not go in a straight line, and you could benefit from trying to time some of that shifting of the ups and downs. But within the sectors, you get these other opportunities of moving from one sector to another, or and even within a sector like commodities, you can shift from silver to uranium is something I've been doing back and forth a little bit. So overweighting one after a great run, and then find that hey, the other one's looking relatively cheap, better risk reward. Let's shift back over again. And I've got Jonathan Lansky this week. He's a multi-decade veteran of Bay Street and the writer of the blog No Straight Lines Investments. Okay. Hey, pleasure to have you. Welcome, Jay.
Kev, I really appreciate you including me in this podcast. Looking forward to it.
You've got a newsletter. Is it monthly, weekly? How often you put it out?
It's weekly. I mean, it's weekly with the caveat that if something happens between issues, like during the week, I will there's been situations where if I've been particularly excited about a story, and as you know, Kev, things happen that require updates, right? Generally, the idea is once a week. It's meant to be a curated macro, and it allows me to flow into the stories and stocks that are most interesting to me at this time. And perhaps, obviously my bias will come through in terms of what I look for, but that's fine.
But everyone should know your style and your time frame and what you're looking at. Me, tailor your advice to a 25-year-old, or what should a 25, what should a 50-year-old be doing right now? And I have trouble with that because it's it's very personal and in the style you want and what your goals are. And some people just want a low volatile return. They don't need a big return. Right. But if you're young, you maybe want to shoot the lights out more and go for it.
Well, and Kev, as again, I'm speaking to a guy that knows this as well or better than I do. I always tell people, the biggest variable, and only the individual can make this decision, is what's your risk tolerance. And the only way to know that is and it doesn't matter whether it's, and I know you'll agree with me on this, whether it's $100, $1,000, $100,000, $1 million, it feels the same, and you put that money in the market and see how you react, right? How do you deal with that? How does your body react to having money in the market? And that's a really important tell for, what should your strategy be?
Yeah, right? Do you end up breaking away from your plan?
Yeah.
Or is your plan physically hurting you? because
How did you behave, for example? I mean, we just went through obviously a pretty dramatic drawdown and bounce back. And, how are you doing on, April 4th and April
yeah,
5th, 6th, right? And
I sent money to my brokerage account from my line of credit
yeah.
and loaded
So,
up, and then I took it, everything I sent in, I took back, and I got I think I got about a 40% return, 30 to 40% return, and
so there you go.
sent it back to my line of credit.
Yeah. Well, but that's a perfect example. Another great thing to show people, and I'm sure you've done this, the long-term chart of the S&P 500, right? Everyone looks at that. But what they don't look at are the little, those subtle little squiggles, the drawdowns and the bounces up. And where do people miss out? They're always selling at the bottom and buying at the top, right? That's what happens because that's what human nature is.
I like to keep saying how we are basically a biological supercomputer with a distributed processing network where, things like gut instincts, having cold feet, these instincts, these regions of our bodies that help trigger emotions and react to things like pain, pain of loss, joy of wins, give us signals. And so there's IQ, which would be do the analytical work on a stock and sector. And then within that, you can tap into your emotional intelligence and start to, as I said, look at the technicals, and you're seeing and looking at social media, and you see right now there is a lot of pessimism and there's a lot of pain in the markets, and people are throwing in the towel, and that literally changes the dynamics of the herd of stock traders in that sector. And you can see it thinning out, right? The bulls are thinning out. People are throwing in the towel. But the nice thing to know is that there's a world of traders out there. And so when a stock may look bad on the daily chart, it starts to look good to other people on a weekly chart. And it maybe starts to look excellent to people on a yearly chart. And the stock starts coming into the 200-day moving average. And so from experience that when a stock starts to look good on these multiple time frames with multiple technical analysis tools, there's going to be a repopulation of the buying crowd, the herd people are going to come and join the herd of potential buyers that are watching the stock now and are ready that want to take advantage of the fact that it's come down to this level, it's at this point, and they step in. And I try to be extremely selective, right? Picking only sectors that I like to go long, and wait for the time frames, for a bunch of time frames and technicals to line up in the sentiment so that I can then go in and I step in heavy. I like to get in, be very aggressive, buy large positions at those points in time. And typically there's a nice rebound that comes quickly, and it allows you to take some profits and then comfortably ride a position to potentially new highs, or, depending on your time frame and the fundamentals, and you're monitoring that position and carrying on. But I use the technicals and the sentiment to get me into those winning positions over and over again. Because it's partly because it's pleasurable to do so. It takes away the stress. Like oftentimes when you buy a stock, you should expect to see at least short-term pain, a little bit of loss over and over again until, as it's doing this and moving its way up, it shows you a loss, then it shows you a gain, then it shows you a smaller loss, then it shows you a bigger gain. And there's an emotional roller coaster that we all ride with that. And the more experience you have in the market, the more you see how other people behave. And, the early years that I had working in a day trading office with like 400 people in the room, you could feel, you could hear, you could literally probably smell the pheromones. Like the energy flowed across the room as people were having big wins or big losses on a given day with news events. Or just plunging markets with liquidity crisis. And you begin to get a feel for when things are bottoming out. You know, we are this supercomputer, biological supercomputer, pattern recognition machine. And I always talk about how when we get to a painful point in our lives where we've now suffered losses, and it becomes common as you become a more experienced trader. You look back and you're in this pain point and you're like, damn, why didn't I take profits? I was flying high a month ago and I had these big gains and I felt great and I didn't take the profits. And now I feel horrible, and I wish I had some capital to deploy to buy these stocks, you know, that are so cheap today.
I have lots of friends who are retail brokers, and I'm always fascinated. You know, what's the phone doing? Like, what was the phone doing after, you know, the aptly named Liberation Day, right? Were clients calling and saying, "Get me out," right? "I don't care. Get me out. Get me out. Get me out," which was, of course, the absolute worst thing they could have done. But you know, that's that whole fear greed pendulum swinging far to the one side, and you know, it doesn't feel good, as you know. I mean, I'm sure you're a veteran. Maybe it did, but it still affects me. I mean, I've lived through all the cycles you have, and even when you think this is nuts, I got to be buying, it doesn't feel good. Right? It's hard.
Oh yeah, it's painful.
Yeah.
Extremely painful. I mean, when I was at Sprott during the drawdown periods, when our shorts were going against us and our longs were going down at the same time, and you're watching hundreds of millions of dollars getting erased on a given day. I mean, everyone lost their appetite for the most part. You just don't even feel like eating. And it's very somber.
Yes.
You know, and you sense the calls you're going to get from the upset clients. You sense the redemptions that are going to come. You know the pattern.
Yes.
Right?
Yes.
And then, funny enough, there's always some clients that seem to mark the bottoms, and it always makes us very happy when all of a sudden they complain and maybe they redeem or whatever, and they always seem to panic, and it typically marks the bottom.
Sort of like The Economist putting something on the cover, right? Yeah. Oil, the end of oil, or the whatever. Yeah.
Eric was always used to joke about how valuable it is to have when you identify certain people that are just like the barometer for the current market conditions. Like, this guy is super bullish. Oh shit, we got to get out. You learn to understand that the narrative changes, that the herd behavior evolves, and it ebbs and flows, and you have to be ready to step back sometime and say, this isn't what I was predicting in terms of human behavior, market behavior. This, and in particular in the early 2000s, I thought it was going to be more of a 29 style crash where it just really dropped and would happen in a year. And it bled out over a couple. It was still a pretty dramatic drop for the NASDAQ stocks, but it took a couple years to bottom. And there was these very painful swings up. And I found that very stressful. And sometimes when I misread them, I lost a lot of money very quickly and almost felt like giving up and thought, you know something, I'm not doing well on this short-term day-to-day thing. I should just go back and do some consulting work and just, you know, my real skill is the longer-term trading, and I'm just going to focus on that. And I should just focus on it. And that was a gut check, a feeling I'd get from time to time. And I overcame it because I started figuring out things, and I just learned to slow down when I wasn't doing well and wait. And I realized that I just had to wait for a little bit more exuberance to come in, and then we're going to resume that trend, and that I would be proven right, and that there, you know, be a little bit more cautious on the shorts and be a little bit more aggressive on the longs when there's a beat down.
I think that's the constant challenge. We've all been told this. There's a million podcasts about this, but you know, you enter a position with a thesis, right? And we are constantly deciding, does the thesis still hold true? What's changed, good or bad? And how should I, you know, to your point, change my position size, remove my position, add to my position. Quite often you'll enter a stock and let's say the stock does well, just to use a positive situation. The stock does well, and then some things happen with the stock that in a really kind of interesting way make the stock lower risk and a better opportunity even after it's moved, whatever it has. I think people have real problems with that. When the opposite happens, stock struggles, the business has changed perhaps. I feel like there's a lot more friction to, because people hate being wrong, right? And it's a really interesting psychology. I don't have a good explanation for it, quite honestly, other than perhaps you don't like to accept that you're wrong.
When I try to sort of judge the ebb and flow of money going in and out of the markets, and what is the reaction, like how much pain, it's being felt in society today when the market's plunging, and
Right.
you then start discovering things about the elected officials. Well, there was Greenspan, there was Bernanke, there's Yellen, right? Now we got Powell. When does Powell step in? When does Powell say, wow, there's too much pain out there, I need to do something, right?
Yeah.
When does Trump, and we've seen it now, right? It's like a tell, right? In poker, right? It's like you keep pushing chips and, I can make this guy fold, right?
Right.
Well, when the market is collapsing, they fold, right? They're like, enough, okay, we got to do something. And whether it's announce a big fiscal spend, whether it's quantitative easing, whether it's, the surprise rate cuts, there's always something. Here, let me pull up this chart I was working on. I was going to do an article on this one here. Hold on here. Right, so this is 2000. You can see here, look at these gains and losses, right? And you think about how much money there is to be made. Like, it's one thing to try to just short and stay short. Well, let's just say you're starting with whatever amount of money, $100,000, right? You saved up to 2,000, and you did well in the tech bull, and now you're going to be, okay, I'm going to short. Well, even if you stay max, you short that first amount, you're only going to make 90% unless you use leverage on your short, right? Right? Like you're going to get a return of 90% or 80 to 90% if you stay short for 2 years. It's, if you were to play the downside, cover some shorts, you only grab 20% there, and then you, out of the 35, maybe you go and you get that first surge, right? You get half the surge. So
then you get 15 or 20, yeah.
And then you resurge again, you reshort again, you get another 20. Right.
Yeah.
And then for me, I would reduce my shorts as the market's getting oversold. It's breaking down. And you can see, I remember that first surprise rate cut, because it hurt so much.
Right.
There's that point where the Fed did the surprise rate cut and it created that first big spike. But
yes,
the market started rolling over, and despite the 50-point cut at the meeting, everyone was anticipating the 50-point cut. You need to say, hey, is the market reacting to this event? Is it surprised or did it anticipate? So it's a good news. Stock doesn't go up on good news. Right? What's going to happen?
It's that whole what's priced in, right? And the only way to, first of all, there's no 100% sure way to know that, unless you're looking in hindsight, because we all know that's perfect. But in advance, outside of that, you basically just have to analyze and listen, and you have to watch CNBC, you have to read reports, you have to do all those things to get inside the psyche, what is being talked about. And even still, it's funny how that particular item, what is priced in, rarely enters the conversation in mainstream media, right? It's all about momentum, and these are the factors that are going to move the stock higher without considering, well, maybe it's already in the stock, right? Uh, um, and again, Kev, you're a vet, you know these things. I think the maddening part of the market, which is also why I love it, because I am not a math whiz, I'm not an engineer. I did a degree in finance, but you know, it's not all science, right? The market isn't science, it's psychology. There's so many aspects of it. To your point, as we've discussed, the nature of the the relationship between the market and human beings, right? It's a collection of human beings that we don't always behave rationally, and that's what makes it so interesting and challenging and also fun, right?
It's the same thing as like in biology, how if you poke someone with a pin and it's a surprise, you're going to get a big reaction. And if it goes from surprise and shock and certain endorphins and chemicals being released to, if you keep doing it, it goes to more anger and annoyance. And then eventually, you basically can become immune to pain in a region or develop a callus. And that's what happens in the market. So this was the other side of what I was doing. I was short in 2000, and gold was moving very slowly. But
Right.
some stocks went berserk, right? Like I got long South African stocks in early 2000, late 1999 when the rand collapsed, because you
Okay.
could buy them at PEs of 5. Some of
Right.
them. Like
Right.
I bought a lot of Harmony Gold. As an example, it had a forward PE of 5, and it was paying like a 3% dividend or something like that back then.
Amazing.
And even though the price of gold only moved up 10-20%, the stock like tripled, in that same
Right.
time frame over the first 2 years. By the time we were at 2002, I think most of my gold stocks had already 5-bagged with this 50% move in gold.
Right.
Relative to this massive outperformance is what I'm expecting this type of thing again. Not in everything, but in what I think is sort of the more overvalued tech stocks. I just think that there's a lot more risk to the downside, slower earnings growth, higher inflation, stagflation, requiring PEs should be lower. And I started doing up a list of how much, based on the slowing growth that we're starting to see in earnings of, say, the Mag 7, how much they could decline and what that would lead to likely a decline in the ETF and other stocks, and then this negative wealth effect. And you start imagining, the many trillions of dollars of wealth lost and the effect that would have on the economy. And then the stimulus response that's inevitably going to come. I listened on one of your podcasts that you were on, I think a year ago. You talked about the early days and you joked that you were in corporate finance for a few minutes, but it was actually 18 months.
Yeah, it's like 15 months, 16 months. Yeah.
One of the themes I'm going to keep going on is how these systems work. Right, and if you think
Right.
about the corporate finance system hires a bunch of young people right out of school to be interns, expects them to. It says you only have to work whatever hours. It's like those contests when you win the boat by hanging on to it the longest.
Right. Yeah.
And there's this element of burnout that comes as a result, and you start asking. I asked the question, who survives this, and what type of people survive it? What is the system breeding? And why did you burn out? I want to give me a sort of a feeling of what life was like and what calculus you made in your head to say, I need to move on. I don't want this path.
Pretty early on that, I would see my bosses in the office Saturdays and Sundays. And so again, so I saw that the writing was on the wall as far as, okay, unless I really, really love this, it's hard for me to see why I would want to devote effectively my life to this business. I had health issues my last year of being a salesperson. I was managing a sales desk, which I didn't want to do. That happened out of need. A bunch of folks left to form Genuity. You remember Genuity, Kev? And so I was made head of sales, and the circumstances kind of are irrelevant. Let's just say it led to me having really bad vertigo. And so I actually had to leave work. So I took 2 weeks off. And so out of this 2-week absence from work, what I decided was I got to change this, right? I can't do this anymore. It's clearly having a huge effect on me. And, like most 30-something-year-olds who were fit, I thought I was bulletproof. I just knew that everything I was doing needed to be changed, because effectively what was going on was my body was in permanent fight or flight mode, and my parasympathetic nervous system was in overdrive, and I needed to switch it back. But what I realized, and what I've continued to realize, is you need to be on top of everything when you are investing.
Oh, it's important. It's the balance is the key for longevity.
Yeah.
Longevity of being able to maintain the balance, right?
Correct.
If you work too much, you end up with burnout. And the burnout, literally, it's disconnecting. It's being unable to take in the data anymore, dealing with the stress around you. It's like maybe you're too sensitive sometimes to it, and it eats at you. The cortisol, the stress itself just wears you down, and it starts taking away your ability to sleep and get nourished, and you're stuck in that fight or flight. I think people understand, if you use the analogy of being overtired or sleep deprived, you're in your own head, you're exhausted, you don't have the ability to look out and sense. You're literally, all your senses are dulled because of your weakened state. This barometer, right? This stock sensing barometer has got too much noise. There's too much traffic, right? It's hard to sense, am I upset about the market? How do I feel? Or am I feeling overjoyed about the market? Or I'm tired, I'm worn down, I'm stressed about, my body's physically stressed from a lack of sleep and jet lag and whatever. You're not gonna, it's like, if you think of it like you have an antenna that senses the market sentiment and it senses the emotion of others. You want to be able to get yourself calm and relaxed and be able to say, how's the market feeling? And be able to not just feel it, but anticipate and say, I can tell, I got a good sense that people are extremely panicked now, and this is likely the low.
So most days, well, not most days, every single day before I sit down and stare at my screen, I will do whatever it is that I need to do. Today I went for a run. I'll ride my mountain bike. I'll kickbox. I'll lift weights. I'll do yoga, whatever.
You literally charge the neurons, you charge the atoms in the molecules in your brain, so they're ready to function.
And certainly being in Kelowna, the biggest advantage is I just don't have to work hard, right? I step out my front door and I ride my bike for 5 minutes and I'm in the mountains. You know what I mean? Like, there's a real advantage to that. You can make it work anywhere, though. I would say that too. You can make it work anywhere.
Well, your hard stop is here.
Yes.
I really appreciate the time.
Oh, guys,
I think there's a lot we can collaborate on going forward. So I'm hopeful that we can do this again soon and keep chatting.
Definitely. And thanks very much. I really appreciate the invite.
It's a great pleasure.
Yeah. Guys, we'll talk soon.
Thanks very much for watching. Hope you liked and subscribed. See you next time.